Welcome to Wealth Coffee Chats, folks, for your daily live updates. Get the most out of today's episode by participating in the chat. Make sure you ask some questions, be part of the conversation, have a bit of fun, grab a coffee or a tea, take some notes, and get ready to start your day, folks. Quick few housekeeping rules, though. No spamming, no advertising or self-promotion in the chat. That's not on. Be kind and respectful to everyone when participating. And most of all, have a good time. Real estate investing can be your biggest asset. It also can be your most expensive asset when it comes to getting it right or getting it wrong, folks. It can be time-consuming, stressful, and that's why here at Positive, we have what's called a 6-star team, a full-service team that provides integrated wealth and property investing solutions and services simply designed to help you progress towards your goal of passive income through your property portfolio, folks. Make sure you check out our other podcasts on the Positive Mentor Network. Not only is there Wealth Coffee Chats, there's the Urban Property Investor. Drops every Wednesday with straight talking investing strategies and lessons with Sam Saggers. Property Investor Tales. This is where our clients, you guys, share real life stories from property investing, hosted by some of our advisors and strategists. And that's done every fortnight, dropping every Monday. Wealth, Wine and Wisdom, folks, that debriefs the week that was in the world of finance and property, hosted by yours truly, Jason Witten and Andy Fenton on Fridays. Welcome to another Wealth Coffee Chats. Marvellous Monday. Hope you're well, folks, wherever you are. If you think it's Get Rich Quick, you're in the wrong place. This is the wrong podcast. This is the wrong live for you. Welcome to another Wealth Coffee Chat. Hope you're all awesome and well. Well, hang on. Got to get this right. Hey, folks. Morning. Good morning. Good to see you. I pressed the wrong button there. Anyway, hey, welcome to Wealth Coffee Chats, folks. Good to see a few of the early birds up and at it already. Well, it's probably not early where you are. Most of you, some of you, are probably well ahead in the day. I'm a bit behind in Queensland. Now, no cheeky punts about that or cheap shots, folks, but good to see a few of it on and up and at it already. Alison, good to see you, mate. Hope you're well. Jeff's there too. Jeff, Luke's in the house. A few of the regulars, which is awesome. Great to see you. There you go. Great to see Jeff. Yeah, it's the last couple of weeks have been a bit crazy, actually. I've been on the road, and it's a little bit tough sometimes when you're traveling to get all the timings right. But here we are, 7:43 on the run. There you go. It is a bit earlier in the Northern Territory. Great to have you with us anyway, Alison. Awesome to see you, mate, even if it is digitally for this moment in time. As we warm up, I'll do the intros. Most of you guys know this, though. But if anyone is new, if you are new to the show, Wealth Coffee Chats, welcome along. Jason Witten is my name. I've been property investing over 25 years. I keep losing track. Anyway, I've been investing for a while. Been through at least 3 different market conditions here in Australia and New Zealand. Invested in New Zealand as well, and done all sorts of deals, folks. I've done secondhand renovations. I've bought discounts. I've strata titled. I've subdivided. I've developed. I've bought off the plan. I've done buy and hold. I've done positive cash flow. You name it. Done every deal you can possibly imagine. Commercial. Only things I haven't done sort of retail-y, industrial-y stuff. Anyway, there you go. Done a few deals along the way. Learnt 1 or 2 things, and helped our clients buy over 10,000 properties, folks. That's a lot of properties, right? Yeah, 22 years in business with Sam and the team, and helped thousands and thousands of Aussies and Kiwis build their property portfolios as they go along. We've got a bit of an aspiration around here. We want to help our clients get to what we call the 1% club. It's 3 or more investment properties in Australia or New Zealand, around about $3+ million worth of real estate in their portfolio. Now, sometimes that's 4 or 5 properties, depending on the price that you buy. But yeah, that's the idea. We know that if you've got about 5 properties in your portfolio, you can do pretty well. You've got a bit of time. Away you go. Anyway, that's the general gist of it. Welcome to the show. And if you're new, say hello. Give us a shout out in the chat. Great to be good to hear where you're from, what you're up to, et cetera, et cetera. So welcome along. Hey, today I thought we might talk about the 3 biggest traps. Let's call them the traps of wealth. Traps of wealth that I've encountered. I've seen as a property investment coach, mentor, advisor over the years, the 3 biggest traps I see my crew fall into when it comes to their investment portfolio, and how we can navigate those as we go along, right? So let's have a bit of a look at the idea over a period of time, over life. You guys have seen a version of this before. We call it the 3 stages of investing, but this one here is the life stages as we go along. Similar idea, similar version of what we talk about when it comes to investing. In your working career, when you've got your income going, well, this is what we call the acquisitions phase, right? Acquisitions phase. This is basically building your portfolio, creating the wealth. I call it the go wide principle. It's actually a bit of a throwback from the good old days when I was many years ago in a network marketing business, Amway. Don't hold that against me, folks, by the way. Friends, family, and tax. Actually, you might be onto something there, Jeff. You might be onto something there. That's not bad. I might use that next time I get going. Yeah, the idea that your portfolio, your wealth, you need to spread your wealth wide. So exposure, if the market goes up 10% and you're exposed to the market, you've got a positive exposure to the market of $1 million worth of wealth, you're going to make 100 grand. But if you've got an exposure to the market of 3 million, you make 300 grand. The market is doing the same thing, but you're getting more exposure, more wealth created. So the idea in the early stages, we call that the acquisition stage, folks, is the idea that you need to buy some properties, right? Get on with it. Wealth accumulation. And, there's some other challenges in there you've got to navigate, especially with kids. Jeff's talking about family, have kids. They can be expensive. You team up, with someone in life and or in financial adventures as well, maybe a partner, and, that can be easier. Get yourself a house, whatever it is. All right. So the acquisition stage, right? That's the first stage. This, what's called here, the financial freedom. There's probably a stage in here that we talk about, which is consolidation, right? Consolidation, which is once you've got your acquisition sorted, you need to rearrange and organize things. And then, you can get into the financial freedom world. And they talk about this, which is retirement. All right. So, there's the idea of these things that are, wealth decumulation. Well, I don't want to see it decumulate. I want to see it move from one generation to the next. So that's what I want to talk about today. The idea that there is 3 big traps for property investors that we need to navigate and we need to understand. The first one, and tell me in the chat if you think you know what it is. What's the number one trap? The number one trap I see with property investors specifically, or let's call it property owners, folks, in the chat if you want to play along at home. The number one trap is what I call the equity trap. The equity trap, folks, right? And how does this happen? What happens here, in with property investors or property owners? Well, what is the general gist? The uneducated, and I say that with respect, not disrespect. I say that with the uneducated, the misunderstood understanding about debt, folks. Debt. Now, the equity trap is caused by most Aussies not understanding the difference between the 2 types of debt as you go. Oh, that's good to see, Jeff. Good to see. Sold the Blackwater house. That is a big win. Yeah, mate. Nice work. Nice work. Got a bit of crypto working for you. Fantastic. So the equity trap, folks, right? So that most investors or most property owners don't understand the concept of good debt or bad debt. Bad debt. And, when I call this the equity trap, what happens? Most people jump into life and sort of they take a 30-year mortgage. And let's say you take a 30-year mortgage and it's 800K. Let's call it that. Now, what's the number one thing that, society and the banks and financial planners and accountants and everyone tells you to do? What do they tell you to do? Chuck it in the chat, folks. What do they say? They say, work hard, and then pay off your home. Pay off your home. Now, by and large, step one of that piece of conversation is perfectly fine, right? Pay your home down, or more importantly, eliminate bad debt, right? So pay your home off, and after 30 years, you'll be all right. Now, is that true? No, it's not true. After 30 years, it won't be right, because what happens over here, let's say you purchased your property at 30. Let's say you bought your home at 30 and you're 60. You got zero debt and your house is worth $1.6 million. This is the equity trap issue. And it's maybe almost an emotional trap issue, because once you've paid debt down, most Aussies get caught in the psychology that they don't want to use this value, this wealth anymore. They say things like, I've paid my house off, I don't want to risk it. Now, fair enough. I understand that. But who are you making wealthy when you've paid your home off and it's not being used for wealth creation? Folks, put it in the chat. Who did you make wealthy? Because here's the thing. Paying your home off, by and large, doesn't create an asset that gives you an income, okay? And, maybe you're going to transform that later on, and maybe you downsize, right size. But put it in the chat. Who did you make wealthy by paying off your home? Number one trap, the trap of equity. Yep, you made the bank wealthy. That's all. That's the only institution, people, you made wealthy. You made the bank wealthy. Now, you need to understand how to navigate the bank as you go along. Got to risk the biscuit. Well, Jeff, you can, as an investor, understand how to navigate this, right? So once you have some debt reduced, we call it debt recycling, transforming, folks, bad debt into good debt, okay? And good debt is where you have some leverage, so you can then buy investment properties, you can buy shares, you can buy other investments with the equity created in that home as a future navigation piece of your wealth creation. All right, the equity trap. Okay. Yeah, and that is the other part, Luke, as well. Once you get a bit older, you've debt reduced, and now you might struggle with serviceability, or, you might be 60 and then the bank says, not going to give you a 30-year mortgage. That's a long time. You go from 60 to 90. I don't know about that, right? So this is the thing. How do you navigate that equity trap? All right. How do you navigate that equity trap? Now, here's the drill. Now, if you've got other properties, and this is the kind of the thing. If in the stages you purchased, other investments, your investment properties, and they went up in value, but your home, you paid the debt off, so your home's debt off, but now you've got equity here from your investments. If you've got equity from your investment properties, that's fine. That's fine. What I'm saying is the equity trap of most Aussies fall into is that they pay off a home without using some of that equity and the servicing along the way to get other assets. Okay. And then, which is fair, you get to age 50 or 60 and you're like, oh shit, I don't want to risk it. I don't want to get, get exposed or that sort of thing. And psychologically, I completely understand that position because it's a fair position to be in. Absolutely, you do. Absolutely. So my encouragement, my teachings for all of you is to, at the appropriate time frame, and it's usually in your 50s. Okay, it's usually in your 50s, Tim. At some point with your home, your owner occupier property, you set up the last lending structure on that property that you'll probably use, right? Okay, you'll unlock the ability and redraw or equity or something. You'll tap some of that equity. You'll set up the loans so you can have access. Now, folks, this is the thing. This is what a lot of people get wigged out about. Oh, I've got a loan, I should pay it off. No. When you get older, if you get rid of those loans, you can't get them again. Right? Now, it's perfectly fine if you've got access to millions and millions of dollars worth of other assets and equity because you've created your investment portfolio. But if you don't, then your owner-occupier property starts to become... I know so many people, folks. I've got so many people who are equity rich who can't shout me a coffee. They're the richest little poor people I know, right? So I could go on for quite a while on this, but I'll move on. This one, equity trap. Make sure you get your equity unlocking sorted at the right times. Okay, there you go. Lending's going to get a little easier, Alison. Sometime soon. Oh, my thing's disappeared. Anyway, there you go. My documents disappeared. Oh, here we go. All right. Lending. The general consensus is that lending interest rates will have some relief first quarter, second quarter next year. That's where we're going. And when it does, folks, it's going to kick on big. It's going to kick on big, I tell you, because there's some underlying demand that needs to be taken care of. Right. Now, I talked about the three biggest traps, right? Okay. Now, the other trap that I see investors make is a structures trap. Structures. And I don't have a lot of time to dive into this today, so I'll just sort of quickly. Now, a person, individuals, folks, I'm not great at drawing these things. All right, he's making a move. So individuals, companies, trusts, and super. They're super, company, trust, people. So these are our structures. These are our tax structures. This is for the purpose of calculating our tax, folks. Okay. And what happens is over time, over life, certainly for those in the world, everyone actually, it doesn't matter whether you're a business owner or a PAYG, but PAYG usually has a little bit more of this structure trap issue than business owners. But what happens? So it's in the beginning, it is much easier, much more effective for most people to buy most of their assets in their personal names. Now, I don't have a problem with that. It's good for negative gearing. It's easy for lending, all that sort of stuff. So, that's a tick in the box, usually for the first kind of, 0 to kind of 15 years, right? 0 to 15 years. But what's the big downside of that? Owning assets into the future, folks, owning assets into the future, well, what's the tax rate of a person, an individual? You're going to get wealthier. Once you own assets, your wealth is inevitable into the future, folks, right? If you can keep them. That's the thing. Buy well, don't sell. And if you do sell strategically because you want to transform out of one trap into something a bit more efficient, right? So anyway, you can pay up to 47%, folks, in here. Okay, 47%. Now, what's the tax rate of a company? 30%. What's the tax rate of super? Well, it can be 15% and 0% on a certain amount of money. And trusts, the trusts have a high tax rate, so you don't keep wealth in a trust, but it flows through. Trust flows through to beneficiaries and what we call bucket companies. Anyway, I won't talk about that because I'm running out of time. But structures trap. Now, owning it in the first 0 to 15 years is fantastic, but sort of the 15 to 30 years, owning it in your own name can have a downside because you'll end up paying more tax than you should. So how do we work that out? Well, there's nothing perfect about investing, that's for sure. You've got to navigate this as you go. Sometimes, certainly when you sit down with Andy and the team, sometimes there's a transformation point in your portfolio where you might transform. You might transform, folks, some of your wealth from one place to another. You might transform some of it into your super and then repurchase and go again. You might transform it into companies and trusts if it's appropriate for the tax minimization in the future wealth. Okay, that's what you might do as you go. And the last part, I'll quickly touch on this, and maybe I'll do something else. Is the trap of not planning in advance the transfer, the legacy of your wealth. Right now, there's billions and billions and billions of dollars going to be transferred into the future to children, charities, grandchildren, etc., etc. Now that's a trap, and it's a trap. Who makes money? Who gets the benefit if you don't plan how to transfer your assets from your world to, let's say, your children or charities or wherever you want to transfer it? Who will make the most money if you don't plan this in advance? It's a trap. It's a trap of not planning. All right. It's a transfer. It's a transfer trap. All right. Who makes the money? Who loves it when you don't plan the transfer of your wealth properly, folks? Who gets the benefit from it? Who makes free money? I think it's horrible. But at the end of the day, it's the government. It's the ATO. Yep, the tax man. Exactly. So transfer in advance. Understand how to transfer your wealth. And this is up here, this section. From this section here, this financial freedom section, to your retirement, what do we do at this section? How do you transfer that wealth into the next generation? Or if you don't want to transfer it to the next generation, that's fine. How do you transfer it into liquid assets for you so you can have a damn fine time, when you retire and do what you want to do? Anyway, folks, that's it from me today. Hopefully that was useful. The 3 big traps we need to navigate and manage: the equity trap, the trap of debt reduction without debt recycling, the structure trap, understanding that not one structure is perfect forever, and we might need to change those and understand there might be a cost in the short term, but there's a benefit in the long term, and not being for the future assets for from one place into the future. Anyway, there you go. That's there you go. All right, thanks, crew. Good on you, Luke. Thanks, mate. Great to have you here this morning, folks. Join us again tomorrow for another Wealth Coffee chat. The team will be there. I think we've got Cass in the property management team up tomorrow, so he'll be answering all your questions around the world of property management. And there you go. All right, I'll see you guys on Thursday. That's it from me. Take care, folks, and bye for now. Episode of Wealth Coffee Chat, folks. Make sure you like, subscribe, and turn on your notifications so you never miss a thing when we go live. Improve your portfolio and investing game, folks, with Wealth Coffee Chats live every morning at 8:10 each weekday. Make sure you join us. Previous episodes